everyone, the viewers, and welcome to this lesson, the business studies. The topic is ledgers. Ledgers is the third topic of the accounting that we are handling in Form 3. I want to bring to your attention the topic that we handled previously, that was transactions. And remember, we define transactions as the exchange of goods and services. And we said that transactions can be, you can have transactions in cash and on credit. We say transactions affect items that we find in the balance sheet. Either they increase or they decrease. And we also saw how transactions affect the balance sheet totals. I want to come to the ledgers, and to the viewers, if you have any question, you can drop your question at the comment section so that we can be able to handle. What are ledgers? Ledgers are books of accounts where transactions are recorded. The transactions already we have defined, and any business owner is advised to keep books of accounts that for every item that is affected by transactions is kept separately so that he or she can be able to monitor how the items are affected. And so that is why we have the books of accounts in the form of ledgers. So if we take, for example, cash is an item. Cash is affected in so many ways because we use it to purchase goods. At the same time, we receive it when we sell goods. So we can be able to open cash accounts so that we are able to monitor the cash in and cash out. When we come to the format for ledgers, we find the format is in a T format. A T is something that looks like this. So this T has two sides. There is the left hand side and the right hand side. So at the top here, we will have the title. Title here is just the name of the item, name of the account. And the left, we have the debit side, and to the right, we have the credit side. Now, each side of that T account has 4 columns. Each side of the T account has 4 columns. So the columns are we normally separate the two sides by a double stroke. So as I've said that Each of the two sides has 4 columns. The columns are as follows. We have the date, particulars, ledger page, and the amount. At the same time, the credit side has the date, particulars, ledger page, and the amount. Each time you are preparing a ledger account, this is the format. Now the date, you write the date when the transaction occurred, and particulars, whatever has affected that account. For example, if we have some money that has been withdrawn from the bank, when money is withdrawn from the bank or deposited, let's talk of deposited. When it is deposited, then we say where is it? Where is it from? If it is from cash, then we'll say that money has gotten into the bank in form of cash. So we'll have cash here, and the amount will be written here. The ledger folio is the reference, some code where we will have to refer later. If you want to check the correctness of the ledgers when you are doing verification. Now that you can do even to the credit side. For example, when cash is used to buy a given item, for example, ABC Limited bought furniture in cash, then that amount is reducing cash in the business, and therefore it is credited. Then we'll have to credit. So we'll give the date and whatever has been used to buy, whatever has been bought using that cash and the amount that is involved. So that is basically the format for ledgers. Now there are rules that govern the entry of transactions in the ledgers. These rules are just like laws that govern the country. They also govern how we make entries in the ledgers. They will help any student, any accountant that will be interested in preparing the ledgers or the books of accounts. They have been categorized into the following. One, we have rules pertaining to assets. So we want to talk about the rules governing the entry of transactions in the ledgers. Rules governing the entry of transactions in the ledgers. One, we'll be touching on assets. Assets of all kinds, because we have two kinds of assets. We have fixed assets and current assets. It is touching on both. That an increase in any asset or any transaction that will lead to an increase in any asset is always debited in the ledgers, while a decrease in the value of assets is credited in the ledgers. I will repeat that rule number one says an increase in the value of assets or any transaction that will lead to an increase in the value of assets is debited in the ledgers, while a decrease in the value of assets is credited in the ledgers. That is rule number 1. Rule number 2 is touching on the liabilities. Liabilities, remember when we were handling the balance sheet, we talked about liabilities, and liabilities are in 2 forms. We have short-term liabilities and long-term liabilities. We gave examples, and you know very well. So, the rule number 2 states that any transaction that will lead to an increase in the liabilities will be credited, while any transaction that will lead to a decrease in the liabilities will always be debited. One of the liabilities, we can give an example, is creditors. Now, creditors are goods that you bought on credit, you have to pay later. So that is like a loan, but it's a short term, because you'll be able to take a short term to be able to pay. So when you again take goods on credit, you are going to increase creditors. So that one is credited. But when you pay part of the creditors, you reduce creditors, and in that way you reduce liabilities, and that one will be debited in the ledgers. Rule number 3. We will talk about capital. Capital is also an item in the balance sheet, and capital is any resource that is used to start a business. We know that very well, and an increase in capital will be credited, while a decrease will be debited. So any transaction that will lead to an increase in capital will be credited, while any transaction that will lead to a decrease in capital will always be debited in the ledgers. Rule number 4. We have the transactions. Rule number 4, expenses. In a business, we must have expenses. We can incur expenses. An example of an expense in the business could be paying for advertising, or paying for insurance premiums. So when the business pays this, that is an expense. So when the business incurs expense, that transaction will be debited in the ledgers. So an increase in the expenses is debited in the ledgers, while a decrease will be credited. While we know very well that there will be no item that will decrease expenses in the ledgers, so we'll always debit expenses. That is why expenses will always have debit balances, because you don't have corresponding decrease in the expenses. Rule number 5 will be touching on revenues. Now, what are revenues? These are incomes that are earned by the business. An example of a revenue could be rent income. That is a revenue. Rent income, you are earning, the business as some rentals are earning income. We could also be having maybe discount received. When you receive a discount as a business, that is an income, and many others. Now these are revenues. Now the rule says any increase in the revenues will be credited in the books of accounts. Any increase in the revenues will be credited in the books of accounts or the ledgers, while a decrease in the revenues will be debited. We know very well that there will be no corresponding item that will reduce revenues. So revenues will always have credit balances. Will always have credit balances. Will always have credit balances. Now, we have another rule that is touching on drawings. Drawings. Now, drawings are cases where the business owners take goods or cash from the business for personal use. You own a business. For example, you have a shop, and then you decide to use part of the stock at home with your family. You are selling bread, and then you decide that because you have guests, you go and take that bread and use at home for the guests. In that case, you shall have withdrawn goods. You have not paid, so it is reducing the capital. Or you have money in the bank, you decide to withdraw that money to use for a hospital bill or for fare to some matanga. In that case, that is drawings. So the drawings normally reduce capital. In this case, the rule says any transaction that will increase drawings will be debited, while a decrease in drawings will be credited. So we'll always debit drawings. We'll always debit drawings in the books of accounts. Now, basically, these are the rules that we'll be able to use when we are making entries in the ledgers. I want to go straight to making entries in the ledgers. Now, we will come to a general example, but for now, I will just talk about a few items and how we can be able to make the entries. So, recording transactions in the ledgers. We will categorize them in the following manner. Let's have recording of stock. Recording of stock. Now, what are stock? What is stock? We know stock is an item in the balance sheet. Now, stock, these are goods that have been bought or purchased by the business owner for resale. Goods that have been purchased by the business owner for resale. That is stock. Now, in not many cases you will find stock in the books or in the ledgers. The reason is stock is in 4 forms. So we always will prepare them. We'll open books for accounts for the 4 and not the general stock. So stock is in the following forms. We have purchases. So these are goods that have been bought for resale. We also have purchase returns. Now, what are purchase returns? Purchase returns are goods that were bought for resale, but because of one reason or another, they have been returned by the business owner to the suppliers. Those are purchases return outwards, return outwards, return outwards, return out. And stock is an asset. This stock here is an asset, and we said any transaction that increases an asset is debited, while a decrease is credited. Now let's start with purchases. Now when you purchase goods, you will open a purchases account. Purchased goods worth 50,000 in cash. Now what are we seeing here? We are seeing purchases. This is purchase of stock. And another thing that we should look at, the purchases have been made in cash. Of course, we have two ways in which you can be able to purchase. We can purchase in cash or on credit. If it is in cash, it means cash is involved. So we are having two accounts we are going to record. We are going to open the ledger accounts for. So we have purchases here. Now, this transaction is increasing purchases, and therefore we debit purchases account. So we will have a date here, 8th of January 2026. The transaction is in cash, and the amount that is involved is 50,000. We have debited because it is increasing purchases. But remember, there is another account here that is being affected in the transaction, which is cash. That brings me to saying that in making entries in the ledger accounts, there is what we are calling double entry concept. Okay, I've heard. that concern is taken. Now, there is what I want to explain about double entry concept. Double entry concept states that for every transaction, there must be account to be debited and account to be credited in the ledgers. So you'll realize that for every transaction that we need to record in the books of accounts, there will be two items. So you'll realize one will be debited and another one will be credited. So in this case, like in this one I've written down here, on 8th January 2026, Mr. Witty purchased goods worth 50,000 in cash. There are two items. You'll realize there is the purchases and there is the cash. So we have purchases. We'll open accounts for the purchases, and again we'll open account for cash. So that is the double entry concept that I'm talking about. We'll use it, and we'll be able to see as we move along how it works. Now in this case, we have opened an account for purchases. It requires that we again open an account for cash. So we can have cash here. Allow me now to wrap this. So that we have cash account as well. We have our T, debit side and credit side. We separate the T, separate the sides by a double stroke. Now, cash is an asset. And if you look at that transaction very well, cash has been used. So that transaction is reducing cash. And we said any transaction that reduces an asset is credited. That is the rule that we talked about. So we are going to credit cash. But we have used cash to buy what? Stock. So we'll have the date here on the credit side. Whatever has been used, whatever the cash has been used to buy is purchases. And the amount that is involved is 50,000. So that is cash account. But remember, we have brought the cash because we were explaining how we are going to record purchases account. I mean, how we are going to record purchases. So we said purchases can be in cash, or they can be on credit. Now, if purchases are made on credit, then still we have two accounts affected. We'll have the purchases account and the name of the person that we have bought the goods from, whom we call the creditor. So we'll have the name of the creditor. So we'll have the purchases account and the creditors account when the goods are bought on credit. Good. Now, let me go to purchase returns. Allow me explain purchase returns. I want to believe you have recorded this one down so I can be able to wrap. Purchase returns. I said purchase returns are goods that have been returned to the suppliers because maybe they are in bad state, they are empty, so the owner of the business may decide to return to the suppliers. Now, when goods are returned to the suppliers, of course, there will be two accounts involved. We'll have the purchase returns and the creditors, or the supplier, or the customer. And this is stock, and stock is an asset. So we will credit purchase returns in the name of that customer, and the other account that is affected, which is the creditor, if that creditor has a name, then we will write the name of that creditor here. But for now, allow us use the creditor in this case. So we are going to credit the purchase returns and debit creditor's account. For example, let's give an example of a transaction so that we are able to see how we are entering it in the two accounts. Mr. Owino, a businessman, returned goods worth 20,000 on 2nd of February 2025. So returned goods that were bought on credit worth 20,000 on 2nd of February 2025 to Omolo. So the goods were returned to Omolo. Now these goods are purchases. So that is what we call purchase returns. Omolo is the one that supplied the goods to Owino. Omolo in this case was the creditor because Owino purchased these goods on credit from Omolo. So Omolo is the creditor. So we have two accounts. We have the purchase returns and Omolo's account. So we are going to credit purchase returns. So we'll have date, the particulars will be Omolo because we have returned them to Omolo. Amount involved is 20,000. But we now, instead of creditor here now, allow me write now Omolo's account, so that now it doesn't appear as creditor because now we have the name of the creditor. We are going to debit Omolo in the name of purchases. So we write the date, and this whatever we are debiting here is the purchases that were returned. Purchase returns. Amount involved is 20,000. So that is how we handle the purchase returns. We credit purchase returns in the name of that creditor, and we debit the creditor's account in the name of purchase returns. In the name of purchase returns. Leave my viewers allow us continue. I want to believe you have recorded this one down so that I can be able to have. I will handle the third form of stock, which is sales. And then handle the sales returns. Sales can also be made in cash or on credit. If it is in cash, then we will be able to credit sales account and debit cash. Why? Sales is a revenue, and we said any transaction that increases revenue we credit. So we are going to credit sales, but if that sales is in cash, cash is increased. Cash is an asset, and therefore we debit cash. So if we have a transaction like Patrick sold goods worth 100,000 in cash on 5th of June 2026. That is a transaction. Then we will have account for sales, and the other account that is affected is cash. So we will have cash because of double concept, double entry concept. We will have cash account there. We are going to credit sales, and then we debit cash, just like I said. So you can have entry here. You write the date, it is 5th of June 2026. Item that is being credited is cash, because we have sold in cash. Amount involved is 100,000. Similarly, we come to cash account and have the date, and we debit in the name of sales. Amount is 100,000. Then quickly, if you have recorded this, we handle the sales returns so that we mark the end of the stock. Sales returns. We said sales returns sales that the business made, but the customers have returned them to the business. They are called returning ones. So they normally reduce sales. So if they reduce sales, sales is a revenue, they are going to be debited. So we debit sales returns in the name of that customer, or the customer that we have sold to. That customer is called the debtor. So we'll always debit the sales returns, the name of that debtor, and credit the debtor. We credit the debtor's account in the name of sales returns. So in that case, we have sales returns and we have the debtor's account. So here we are going to debit here. So if for example we have the date is 10th of May 2024, and then we have the sales that were returned were from maybe Akinyi, then we'll write Akinyi here. Amount is even 20,000 that was returned. Now in this case, instead of debtor, we say now Akinyi's account. Akinyi was the debtor. Now we credit Akinyi's account, of course, in the name of sales returns. So we'll write the date, and then we'll write sales returns. Amount is 20,000. Amount is 20,000. So that is how we make entries when we are dealing with stock, the four forms of stock. Want to stop there. We'll have a break for some minutes. Then when we come back, we will be able to handle now the other items in the balance sheet, the other accounts. So we have several accounts, but remember they fall under the categories that we talked about: the assets, the capital, the expenses, the drawings, and the revenues, and of course the liabilities. We'll be able to have an elaborate example so that we see how we can be able to make entries of those accounts. Thank you, and enjoy your break for a few minutes. We'll be back.